Hey, Open Trades! I want to do a video analysis update on the stocks on the Strangles screen. I noticed that there was a pretty big growth theme in Roku. This 75 strike call and the 60 strike put was the one that caught my attention. There's a few other ARK classics, so I picked a few out. Roku, Tesla, Upstart, Apple. Apple's not an ARK, but a few others just to get some value in there and call it a Wednesday. So I'm pretty interested in a lot of these option selling ETFs that are on these new growth stocks. They don't have one specifically for Roku, but they do have one for ARK, OARK, and they do have one for Square Cash and PayPal. And they have two for Apple, and they have two for Tesla. So YieldMax has a lot of these. Curve, KURV has a lot of these. And so whenever I see stocks or sectors that have these very high premium ETFs, and I think they have bullish setups, what I like to do is I like to blend the underlying with the high yielding option premium collecting ETF. And a lot of these ETFs alone, because they're actively managed out of the money synthetic covered call ETFs like the ones with NVIDIA and Coney, CONY for Coinbase, some of those that I've held have just done well on their own. The total return calculator for free gives the results for all that. And a lot of these YieldMax ETFs, Facebook's, FBY, and Microsoft's, and now with Curve, they're adding their hat into the bucket, potentially getting 2 dividends a month, assuming that their distribution schedules stay the same. Anyway, some of these names, especially the ones in ARK and the NASDAQ, there's a lot of ways to, for me, to collect option premium from ETFs that is not subject to exercise risk because it's through the basket of ETFs, whether they're through out of the money synthetic covered calls, 0 DTE puts, and 0 DTE calls now even for iSpy. So Roku was on this screen. I think from this low, there are two ways to look at it from an Elliott wave perspective. And really, this ABC correction from this high is the most important. I think the best count is that this is an expanding diagonal. It's 1, 2, 3, 4, 5 waves up, wave 1, and ABC, wave 2. So the 78.6% retracement is 53.32. That's a little wide, but it's a pretty nice invalidation. And then this invalidation is 55.02. I think that's a little more of the just right level, but they're pretty close together. So I'm going to write long-term invalidation zone. And really it's this low of 55.02. So this could be a wave 1, an ABC wave 2 between the 61.8 and 78.6% retracement, and a wave 3 beginning. It could also be 1, 2, 1, 2, and yes, another 1, 2, wave 3 of wave 3. I think that's a perfectly valid count. And it's one of those classic ones where from this low, 1, 2, 3, 4, 5 waves up could be the 5 waves of a wave 5, or it could be the 5 waves of a wave 1. I do think that this is an expanding diagonal though, and I think that this low, however, of 55.02 might be a better invalidation. So either way, 2 slightly different counts. I think they send a similar message for Roku, and I think that might be what the institutions are thinking. So I own ARK, I own OARK, and some of these other ARK setups are looking good. Tesla, I've owned and I hold Tesla. If it really gets going, and Tesla, TSLY, I've collected dividends from that for a bit. It's probably the one YieldMax ETF that has not been a super shining star in my portfolio, but it has given me huge dividends for a long time. And when I originally took the biggest position in, I did not do an automatic drip campaign. I took a pretty large lump sum position in Tesla Commons in the 159, 155 area. And then with this ABC correction, I took a pretty substantial Tesla position. And then I collected dividends this entire time. And I really just used those dividends and reinvested a few on some of the dips. But it hasn't been the biggest total return winner the underlying commons for Tesla have. And if Tesla does really start to firm up in this wave 3, I'm probably going to buy TSLP from Curve slowly with AAPY and GOOP just to get 2 dividends a month. And Curve's option selling strategy is a little different than Tesla's. What I've noticed, or TSLYs from YieldMax, what I've noticed is they use much closer expiration dates than the YieldMax ETF. So in different volatility environments, there could be different outcomes. Apple and Google and Netflix and Amazon, their implied volatilities are usually a lot lower than Tesla's. So that might be a little more Greek analysis that I'm happy to do. I'm not sure that that would be the biggest audience on this page. But anyway, an ABC correction in a 1-2, 1-2, wave 3 of wave 3, but beginning from this low is what I'm expecting. So this is going to be invalidated. It says 175.01. I think that was the 78.6% retracement of this. But now, the real invalidation is this from this low, wave 1, and an ABC wave 2, wave 3 forming. So I'm going to keep holding Tesla, and I'm going to keep holding TSLY, and I'm going to keep holding ARK, and I'm going to keep holding OARK, and I'm also going to keep holding NVIDIA, and I'm also going to keep holding CONY, and I'm also buying MRNY, I'm buying SQY, and I'm buying PYPY. Those are Moderna, Square Cash, and PayPal out of the money covered call ETFs, and AMDY, AMD obviously, and oh man. Anyway, I'm not gonna. Back to Tesla. Above this low of 152.37. Tesla and Roku. It could just maybe it's sticking a little more with Tesla. Tesla can enter wave 3. Roku can enter wave 3. I was gonna bring up, and I will do Square Cash and PayPal, but Enphase might be a little more of a Tesla correlate. In the big picture, I'm not one of the people who talks about CEOs buying the stock. The CEO, though, for this stock has called the bottom recently, and he's bought an awful lot of shares. I wonder if he has a gambling problem, but he's really confident, so I don't like to use the term bottom call, but anyway. 1, 2, 3, 4, 5 waves up for Enphase, wave 2 and wave 3. It might be supporting evidence for Tesla from this low. 1, 2, and then, dare I say it, what's this? Another ABC correction perhaps for Enphase. Possibly another 1, 2. It could happen. That invalidation, 93.52 for this high beta sucker. I own Enphase from 160-ish. I'm excited about it. And Pan, I talked about unusual options volume on this one. Oh, I must have done this on a guess to count. But tan in the solar sector also for in-phase energy. And Tesla. And this is where ARC can get pretty broad. And that's kind of what the fun part of this video was, is that it does, maybe it is this broad arc. The market gods said, hey, wait for all these new covered call and zero DTE selling put ETFs to come out, then really profit from this like a MM. If it's anything like what's happened with Nvidia and Coinbase and Microsoft, MSFO and Facebook and Amazon, and pairing those together, and I'm now even pairing Apple and Google together. And that's just the equity side. They have these on treasury bonds now. SoFi, THTA competing with HIGH, who can get the best and safest 10-11% yield from treasuries. So anyway, that might be enough supporting evidence for, or maybe it won't be, but just to get back on track with the strangle screen. I've covered First Solar recently. It could also be from this low of 129.22 and 121.59 being a more reasonable. That 61.8% retracement. And validation for this longer term count, 121.59. This low is 129.22. Might be supporting evidence for the clean energy side of ARC. Maybe the more software side, Upstart. Destroyed this. One of the biggest FinTwit gurus. His whole claim to fame for 2023 was barely what I did with Upstart. And I just casually mentioned Upstart and slaughtered it. And anyway, congrats to him. I'm not sure if he's going to come out and talk about Upstart again until it's back in the 60s or the 70s. But I think this is 1, 2, 3, 4, 5 waves up. Wave 1, wave A. Wave 2, wave B. Perfect hit. Now it's right back down to the same stop. Wow. See how easy this is? Never call it easy, but when the LA wave's done right, sweet. Back down to the same stop as before. The original stop was 19.84 for wave 1 and wave 2. Now for wave 3 of wave 3, it's 19.84 again. So Upstart probably has some dystopian background I don't know about. Apple, I know about theirs. They're buying Strangles on Apple. Notice it's down after hours, so they can buy against those Strangles they bought during the market and after hours and neutralize that delta. It's the little things. I think 164.91 is the more reasonable validation. I smoked this. Oh well. Just so happens I said, wow, a quad witching rotation for Apple. What happened? Apple and Google announced the partnership. And my most recent post before that, the largest position I took was in Goop, G-O-O-P. Anyway, them announcing that nice partnership on the first day of after the March quad witching, which I define as the March quad witching. Any quad witching day is always just going to be that biggest, most liquid expiration, and it's always clear because it's going to be the first one that's available years out. So whatever the March expiration for 2025 and 2026 is, that's the March quad witching. Whatever the September expiration I can buy for 2025 is, that's the September quad witching. So First day after that 315 March quad witching, we hear this news about Apple, and now the MMs get to raise the strike prices on their Strangles, Verizon, Arbor Realty, the dividend payers. They use these Strangles, they use these straddles to buy shares of these risk-free. And of course, it's not really risk-free, but if they're quants and they know that a volatility expansion move, see, in the options market, it's not just about betting on up and down, it's also about betting on volatility being flat and then wide expansion. They have various technical indicators for these. I think the Bollinger Bands are the most popular. But when the Bollinger Bands are super, super tight, generally speaking, applied volatility is going to be at a big trough. Options are cheap. Institutions aren't looking for a big move. Retail isn't looking for a big move because the Bollinger Bands are super tight and everyone's forgot about them. That's when option premiums are generally cheapest, those tight consolidation ranges. So if they think that volatility expansion is going to occur, that out of that classic triangle, whether it's to the upside or the downside, they can buy Strangles and straddles. And for dividend-paying stocks, playing that with a married put for a delta neutral position where, say, 35 shares are bought with a put that has a delta of 35, or if a straddle and strangle is bought that's delta neutral, and then Verizon goes down, so the put delta goes up, they can neutralize that put delta by buying shares based on how much the put delta went up. Say it was delta neutral, the downward move caused the straddle, the strangle to be negative 25. They can buy 25 shares of Verizon risk-free. They're still going delta neutral. And if Verizon keeps crashing, they're still playing the volatility expansion, but they're collecting a dividend too. So I think they're doing that with Verizon. I can't tell that to my broker, but that's why I don't trade on leverage, and I only invest what I can afford to lose. Anyway, Arbor Realty Trust, another one. Pretty count. Interesting volatility out of Arbor Realty Trust, 13% dividend, and interesting long-term total returns blindly averaging. Past performance never indicates future results. And I don't really quite feel like marking this one up. But yeah, the real estate sector, Dynex Capital, AG&C, some of these real estate stocks are on that unusual options volume screen, and they're mostly biased to the call side. I had a RQI in a video recently, and really just as rates fall, the yields fall, the asset prices, who knows, but the institutions seem to be playing that in the options market. The wave theory says that type of conventional wisdom might work for real estate and bonds. They might reward the fundamental traders playing the rate cut, but without Elliott Wave and the options quantitative risk management, it's going to be really hard to hold those positions playing what comes out of Jerome Powell's mouth next. Obviously, this channel doesn't give a damn what comes out of Jerome Powell's mouth next.